A very good afternoon, everybody, and welcome on behalf of EFAMA to this afternoon's session on the future of DC pensions in Europe, which is going to be looking at the critical question of how we create a thriving pensions landscape. And I think the importance of this subject has just been recently illustrated by new data from Insurance Europe, which showed that around a third of those who participated in a recent poll were not saving for retirement. And about a fifth of those who participated felt that their retirement savings had been damaged by the COVID experience. Of course, unfortunately, we're not quite through that COVID experience, but we still need to think about some of these very serious issues together. And I'm really delighted this afternoon to be joined by such a distinguished panel to discuss these questions. I'm going to introduce the panelists briefly. I'm then going to set out the structure of our discussion this afternoon, and then we're going to go straight into it. I should mention that at the end of the session, we're going to have an opportunity for Q&A. You should be able to send in your Q&A actually at any time using the facilities on the screen, and then we will pick up those questions probably at the end, but if I see anything or we see anything along the way that we feel we can pick up as part of the conversation, we'll certainly do so. So let me just go round by order of appearance on my screen to introduce the panelists. Firstly, Gabriel Bernadino, who I think everybody will know as the former chair of EIOPA, but who has recently taken up a new position as chair of the CMVM management board, the Portuguese supervisor. Many congratulations, Gabriel, on that appointment, and delighted again to have you with us this afternoon. And we're also joined by Pablo Antolin, again, who probably needs little introduction as principal economist and head of the private pensions unit at the OECD, and I don't think from Pablo's backdrop we can be in any doubt about where he's from this afternoon. So welcome, Pablo. So alongside these two extremely distinguished policy participants, I'm also delighted to have representatives from the European investment management industry with us this afternoon. Again, just going across my screen to welcome you, Ankul, who is co-lead of the Global Retirement Strategy Group at Vanguard. We have Patrick Tissot-Favre, who is head of international business development for the Amundi Employee Savings Group. And last but certainly not least, Kristof, Woutters, who is global head of pensions and insurance relations for Candriam. So a very warm welcome to all of you. So we've got quite a bit of time for discussion, and that's just as well because there is a lot to get through. How we're proposing to break this up is into really four segments. We're going to start with a scene-setting segment from Pablo and Gabriel, just to talk about today, how does the DC pensions market look? What are some of the obstacles to increasing participation and ensuring that the market thrives? And then we're going to go into a segment about how we think the authorities, government and regulators can improve matters. We're then going to talk about how the industry can from a market perspective, drive improvements. We're going to talk about digitalisation, of course. We're going to talk about the power of ESG. We're going to talk about investment strategies such as life cycling, and really try and look at how the industry can deliver for European citizens in the most innovative and cutting edge manner. And then we're going to move to a final segment, and certainly last but not least, to talk about the concept of value and how we can ensure that pension savers across Europe get value for money as we ask them to entrust ever increasing amounts of their own savings to pensions institutions and ultimately capital markets. So without further ado, I would like to move into the first segment and invite Pablo, who I think, as many of you will be aware, has some unique and extremely well-informed perspectives on not just the European market, but the market internationally, to offer some perspectives on where we are in this journey towards DC, both the second and third pillar, and what he sees as some of the obstacles to a thriving market. And then we'll start to pick up some of those thoughts as we move through the rest of the debate. Pablo, the floor is yours.
Thank you, Jonathan, and thank you for giving me the opportunity of being here. I would like to start with highlighting that we tend to think of Europe as a monolith, but the reality, and I will be mentioning a few examples, is that there is a very large variety across European jurisdictions of where the DC pension market is. And looking at that variety allow us, that variety and the differences that exist across European countries allow us to start answering the question of how to create a thriving DC market in Europe. So let me just say, for example, in defined contribution pension arrangements, probably we will all agree that they are thriving in the UK. They are the main form of saving for retirement in countries like Denmark. They are also one of the key consolidated mechanisms to save for retirement in Sweden. But yes, there are other countries like France, Germany, Netherlands. Netherlands has asset back, but they are defined benefits, and now they are discussing about moving to defined contribution. Spain and Italy and others, in particular in Central and Eastern European countries, that the DC market is not thriving. So what can we learn from this difference is the first question to that, because we see a large difference across European countries. I will bring in the other side of the Atlantic as well in a little while. And then the other question that is important is you talk about the second and the third pillar. We tend more to talk about the occupational or personal. So the question is, do we want defined contribution to thrive in an occupational environment or in a personal plans environment, or in both? And on top of that, and you will see shortly why, how do we distinguish, or do we want to make them voluntary or mandatory? This is one of the key issues. So why do I mention all of that? Well, the distinction between mandatory and voluntary is very important when we look at different countries, and the distinction between occupational and personal is also quite important. For example, in the UK, it's a voluntary, but it's occupational with auto-enrollment. It's not mandatory, but it's somewhere in between. It's thriving. In Denmark, it's mandatory, what normally is called quasi-mandatory, because it's reached by collective bargaining, and meaning agreement between the social partners, whether at the firm, at the sector, or at the national level. That changes depending on the countries, but in this case, it's more at the national level and at the sector level. So individual DC arrangements have been a long time there, and they are more or less mandatory, as I say, through collective bargaining. And it's the main mechanism to save for retirement in Denmark. Then we have Sweden. 20 years ago, they introduced mandatory defined contribution accounts, always with the idea that they will be one of the mechanisms to finance retirement, not the main, but one of them. And it has been thriving, and we all know examples of what is going on. It's true that the amount of contributions that go into the mandatory defined contribution individual accounts is not very large, but it's thriving, taking into account that. But as I say, there are many countries where the DC market is not thriving. One of the reasons is argued, for example, there are not thriving defined contribution market in the Netherlands. The Netherlands have a funded pension system, but it has guarantees, and it has the most extreme of guarantees. It's a defined benefit plan. So obviously it's difficult. In Central and Eastern Europe, but also in Germany, there are guarantees, and all those systems are voluntary. In the studies we have done of the Czech Republic, Slovenia, the Slovak Republic, and now of Poland, well, they are voluntary, and in many of those countries, they there are strong guarantees, which means that these systems don't, defined contribution system don't thrive, because a guarantee basically means there are some degree of defined benefit. And of course, the way they manage the assets and everything changes completely. In other countries, the public pension system, in particular, the level of the contributions to public pension basically crowds out the market. This is the example of Italy. In Italy, 33% goes to pensions, to public pensions. And in other countries like Spain, well, this is a factor, but also the personal plans, not the occupational plans, but the occupational plans are not available to everybody, which I will be referring to that shortly. And one of the key factors, the occupational plans in Spain, they are not available to everybody. They are available to very few type of workers. The public pension contributions crowd out the market. And on top of that, the personal plans are quite expensive in an international comparative. The occupational are not. I will add now the perspective from the other side of the Atlantic. For us, it's always very important to look at other OECD members. And here I will just talk about, well, Chile, Mexico, and Colombia. They have thriving defined contribution pension arrangements. They are mandatory, and they are linked to an employment relationship. They are sort of occupational because in the case of Chile, according to the OECD classification, they are not defined as occupational because they are not sponsored or set up by the employer. Then they are not classified as occupational, they're classified as personal, but they are linked to the employment relationship. And this is very important. And then if we look at the US, it will be difficult to argue that the defined contribution market is not thriving in the US, and there is a lot of innovation coming from that country. In the US, it's voluntary and they are occupational. 401ks are occupational. They are offered by employers. And in the US, there is a lot of behavioral nudges to participate and to save. And this is also very important. One issue that I always comes out when talking about the US, some people argue that US citizens in general, they are more in tune with the idea of saving than Europeans. It is true to some degree that the mantra of do it yourself seems to be stronger in the US. However, there is a lot of people in the US that don't save in defined contribution pension plans for the same reasons. Well, for one of the key reasons I mentioned in the case of Spain, they are not offered, in particular for the small and medium firms. It's voluntary, it has to be offered by the employer, and many times they are not. Now they are trying to create collective arrangements in order to be offered to small and medium-sized, to employees in small and medium-sized companies. So to conclude and leave the room for a lot of discussion, I would like to highlight a few points that I've been referring to them that might help to create a thriving DC market in Europe. And all this point comes of this comparison I just made. First, compulsion or quasi-compulsion through collective bargaining is quite important. Not to have hard guarantees like defined benefit systems or soft guarantees, low returns that leads to, well, soft guarantees that leads to low returns, which makes those systems unattractive and people don't participate in them. It's also important. Being linked to an employment relationship, being in some degree occupational, is also very important because the employer involvement, sometimes only on informing individuals, can be quite powerful. In the personal environment, it's important to have defined contributions, but it's important that fees in that environment are match the cost of providing those services. Behavioral nudges and financial incentive for participation and saving in DC pension plans are quite important as well. And the example of the US is quite telling on that. The availability of plans, the availability for people to save in those retirement plans, the possibility of saving is also very important. We find many countries that there are very good plans, but people cannot save on those plans. And finally, we have faced many times in many countries when we assess the system is the trust in the system. The systems have to be well regulated. There have to be appropriate defaults to protect people, and guarantees should not be part of this default. The defaults are to protect people, but also choice. You have defaults and you have choice. People can choose. And there has to be choice in order for people to match the risk profile to the type of investment policies available. And it's essential, and this is why sometimes the employer role becomes important. It's essential good communication and information campaigns for people to understand what are the choices, what do they have, what are the implications. And we will talk at the end of the day on the value for money, which is also a very important issue here. So I leave it here. Thank you.
Pablo, as always, an absolute tour de force, and thank you very much for covering so much ground in such a short space of time, and setting up really a number of critical themes. As I mentioned earlier, we're going to come to some of the solutions in a moment, and look at what the authorities could do, and talk about some of these dilemmas around mandatory requirements versus behavioural nudges. But before we do, I'd just like to bring in Gabriel for an initial set of comments around the diagnosis. And perhaps, if I may, Gabriel, to start with an issue that I think the industry and you discussed extensively as part of the PEP development process when you were still at EIOPA, around this point that Pablo raises in terms of trust, and particularly the context of trust potentially being linked to the idea of risk, and a world, of course, where DC shifts that risk onto many millions of individuals who will often not think of themselves as investors, often be attracted by the concept of a guarantee and be looking for perhaps something slightly different. So I would really like to hear an initial viewpoint from you on this question of trust in capital market risk, and how you see that as we make this longer term transition.
Yeah. Well, thank you very much, Jonathan. And first of all, let me thank EFAMA, and by the way, also all the other organizers of this European Retirement Week. I think it's a wonderful opportunity and a great idea, and to put this issue of retirement and retirement savings on the table of EU and national policymakers. I think it's an extremely good idea. So, well, trust, of course, as Pablo mentioned, is and should be one of the elements, of course, of one of the bases of moving forward in a thriving DC market. Is there some distrust from the public and from the policymakers on capital market risk? I think to some extent still yes, and for a number of reasons. I think there's an underlying element which is somehow the loss aversion. I think it's more loss aversion and risk aversion that we as individuals, and then of course this goes out also, I think, in terms of the professionals in the financial sector, still have this kind of fear of market volatility and the implications of that. And somehow, here and there we see still, of course, some ideological mistrust in markets. I think that's a reason also why reforms in this area don't happen very often as we probably would need. But at the same time, let's also be honest. There are some underlying elements also of the reflection and the lessons that both policymakers and people take from what happened in the markets in the past. We have seen, of course, some conduct issues, some conflict issues within the sector. There's, of course, issues related to the behavior or somehow the bad behavior of some market participants. That gives this, I think, idea that capital markets, you cannot just trust them. And at the end of the day, this still impacts, I believe, in the feeling of the public and the normal citizen, and consequently, of course, it has an impact in policymakers and in the way that policymakers look at this. Now, I think that what is really relevant is to also try to make a clear link with what is a defined contribution product, and what are we talking about when we're talking about risk in a DC concept, and what is market risk in a DC concept, and that I think is a very important discussion, and actually we had that discussion very deeply during the setup of the PEP in Europe, and I think that that's a very key issue for the overall public understanding, but also for the policymakers to deal with it. We cannot look at at DC and retirement savings as a short-term type of product, because in there, of course, you will see the clear effects of market volatility, and that happens, and we all know, of course, that markets are volatile. Now, when we're looking from a medium and especially long-term type of mechanism, like it should be a truly DC pension mechanism, then of course this short-term volatility means much less. The risk, I would say that the risk in a pension environment is especially linked to the fact that you don't achieve your pension objective, your retirement objective. And that's something that will end at the end of the period. That doesn't, it doesn't mean nothing what happens tomorrow in the markets. And of course, that is different from different cohorts of population. So when people are younger, they should definitely take more risk in this kind of products because they have sufficient time, of course, to deal with market volatilities. When people are close to retirement, they need to be more careful in terms of the allocation. But there are processes to deal with that, and I think that this education, in terms of what it should be the truly nature of a long-term type of retirement savings product, I think it's essential. And it's not only the education, by the way; it's also the way that you design the products. It's also the way that you design the metrics, the performance, the benchmarks. Because if for example, if you continue to use a short-term type of benchmark or a short-term type of information metric in relation to a pension, long-term pension product, the same as you use for a normal investment, short-term investment product, then you're giving the wrong impression to people. Then you're giving the wrong message. And so I think there's an overall change in cultural attitude, but also from our side, from policymakers and from the industry, by the way, to have a different narrative on what it makes sense and what is really the relevant elements on a long-term type of product. Now, I think it's very important also that we understand the differences that this low yield environment that we live already, in Europe for more than 10, 15 years, and that will probably continue to live a couple of years more, what it means really is for the type of products that we have out there in the market and how capital market risk can, of course, be seen in this. Because traditionally, as we know, and Pablo mentioned it, in many European countries, pensions was done through guarantees in one way or another. And that was, of course, very much something linked to the sense of security that you as a citizen you want to attract to something that you're putting aside for your retirement. So traditionally these products were definitely the preferred ones. However, when we start to enter into a low interest rate environment, and as time goes by, of course, these products start to have less value. And also what we've seen in Europe was that, a number of these products that were done on the insurance sector also, with a better reflection of risk in the capital of insurers with Solvency II, then of course these products became a little bit more costly. Guarantees became more costly and so less attractive. But then you can think, okay, but then non-guaranteed products will strive in Europe. And that's not the case. And why it's not the case also? I would argue that's not the case because of a number of reasons. One of them is that there's hugely atomized, fragmented type of products right now, looking at this segment of DC pensions, especially on the individual side. And the experience, let's be honest, of this in terms of the final outcome, the real returns to the citizens, in many cases have not been the best. And why? Because the costs and the charges of this non-guaranteed type of DC products, the costs and the charges have been quite high. And in the past, of course, when you have high interest rates and high returns, this was, of course, somehow tolerated when you see the final figures. Now, with the low interest environment in which we are, this bites a lot and eats a good part of the return. So the real returns at the end of the day, also in some of the DC mechanisms, have not been, I would say, the best for the citizens. And of course, all of this brings, I think, somehow an ambience of distrust in some of these mechanisms. Now, I just wanted to point it out also one element that I think it can be a relevant element also in this equation and in the diagnosis that we do. And it has to do with what is the way that the young generations look at risk and look at markets. And that, I think, it's a very important element and should be considered by all of us also as policymakers. I think that in the latest years, and especially with COVID-19 and all the pandemic influence, we have seen a huge number of new, especially youngsters, come to the markets, to be much more prone to trade and to have a presence in the markets, be it traditional markets, be it somehow also as we know through crypto, for example. And this is somehow a different attitude probably to risk. It has its, I think we should be concerned in some way because many of these people probably don't have the literacy and the understanding of how these things work. And then probably, when this may be short-lived because when these markets will correct, and we know that they will correct, it's a question of when, then we may face, of course, quite a strong reaction. But I think this is a huge opportunity also to bring these more young generations, people that are starting to entering also the workforce right now, to this idea of really having a long-term savings plan through DC mechanisms. And I think we should use this as an opportunity, as I said. So I think the diagnosis is done. I believe that, Jonathan, we will talk a little bit more about, of course, what to do, what is possible to do, and what should we do. But I think there are reasons, of course, for this less, I would say, enthusiastic and trustable approach to long-term savings in Europe in relation to other countries in the world. And of course, as Pablo mentioned it, this is not the same throughout Europe, and so we can learn, of course, from the lessons from a number of countries throughout Europe. But just to give you an example, how can you push a lot for defined contribution private pensions? For example, in my country, we have a 34% contribution rate to Social Security, to the first pillar. 23 from companies, 11 from employees. This, makes it very difficult, of course, to have a complementary private pension mechanism, be it occupational or individual.
Absolutely. Well, thank you, Gabriel. That again, I think, set up a number of really important themes that we're going to come back to throughout the discussion. I'm going to bring in some of my industry colleagues in just a moment. But as we move to the question of what can be done, I wonder, Gabriel, just staying with you for a few minutes, if you'd like to sort of just pick up a few of the themes that Pablo raised, because of course, in the UK, but also in the US, we've seen some behavioural solutions to some of those issues that we've identified. So when we've talked about the importance of education, we've talked about risk aversion, we've talked about distrust. all of those, of course, need to be addressed, and we'll talk about how we might do that. But there's also a way of cutting through some of this by simply mandating saving or using automatic enrolment. There's also the question of whether we've got the right combination of state and private sector information systems, such as dashboards, to get to the kind of baseline that supports people who otherwise will find it very difficult to do what everyone else thinks is the right thing that they should do. So perhaps you could just give us just a few moments on those themes, and then we'll do a broader tour de table.
Can I start with that, Jonathan?
Absolutely, yes, please do.
Very good. Yeah. No, I think there's two key elements in here. One is awareness, and the other one it's some level of compulsion, as you mentioned. I think on the awareness side, a lot can be done. And again, picking up on the best practices that there are throughout the world and also in Europe, that was the idea when I was still at EIOPA, to develop these pension dashboards and national tracking systems and good practices for that I've seen EIOPA launched yesterday. And this is very important because awareness is the first element, and awareness both in terms of the member states in Europe, and to have somehow some unbiased and comparable data that you can use for decision making, and also to integrate in the policies from the EU Commission side, and I will come back to that. But also, the national tracking systems that prove to be very effectively in people's understanding of planning also they're safe for retirement. It's, I think it's the latest number that I've seen, 20 member states in Europe still don't have a pension tracking system. And I think that this is something that it really needs to be catched up, because also in the countries where you have this, and I've seen very good examples, Denmark, Belgium, and others, very good examples that show that when people are, understand really what you have, what is going to be your retirement basis, then they are much more prone to take somehow action from themselves, and also to push the discussion at a national level in terms of reforms in these areas. Awareness, I think, is fundamental, and I'm quite happy that at the European level, the Commission took this step really to take this as an important element on this journey towards better pension and more adequate pension. But then auto-enrollment, and I understand that, of course, this is very political. Let's be honest, and any level of compulsion anywhere, it's always very difficult from a political perspective, and we know that there are ideological also elements behind this. But I think, and that's the way I tend to look at it, I think we should look at from a very much pension provision adequacy basis, and the idea of complementarity between types of systems. I think it's one of the ideas that proved to be a winning strategy, and so I think auto-enrollment can really be an important mechanism to increase both the participation and also the volumes and the amounts that, of course, you save for retirement. We all know that as individuals, people suffer from behavioral biases. We have limited financial knowledge, and this prevents people to engage and to join these mechanisms at early ages, where they should be doing that. So I think that an element of auto-enrollment, preserving the choice of people precisely. But we know that the inertia works also in here, and I was looking at the numbers from the UK, for example. The latest ones that I've seen, it's only 9%. 9% of people opt out, so it's clearly something that works. Now, I think there's a very important element in the implementation of any kind of auto-enrollment elements, in order to increase not only the coverage but also the amounts that are saved in the private mechanisms, which is the linkage, of course, to the first pillar of Social Security. As I said before, in countries where you have a high percentage of contributions in the social security, in the public social security, if you want to change this, you create an issue, clearly a transition issue with the funding of social security. You know, if you want to reduce the contributions of the first pillar in order to allow for, you know, contributions to be made through an auto-enrollment process to a private pension or conventional pension system, you create a funding issue at the social security, at least in a moment in time or during some period. So this needs to be tackled somehow. And I think that what I would believe is that there should be a role for Europe, you know, in this, because I think it's impossible, to be very honest, or very difficult in each individual country to take reforms like this without the support also from a community level. And the support could be there, to be honest. I mentioned this a couple of times in the past, by making pension provision and pension adequacy really a central basis of economic governance in the EU. And I think this is a very important element for the EU, because it will really link the citizens, the EU citizens, to the EU project. And so what could be done, to help this transition phase and this funding element in the social security? If you introduce auto-enrollment with alleviation of contributions in order to fund this, we could as Europe, launch some debt at European level, as we have done recently now with the post-COVID recovery, which will lower significantly the costs of funding for countries that are, of course, have more economic difficulties, and will allow this funding, of course, to be done at much lower levels, and that the money that is used to fund this transition should not be considered, overall in the Stability Pact in terms of the economic governance discussions. This could be something that Europe could do to really boost the private pension in a long-term way, and DC could be part of this, definitely. Of course, good regulation, then good design, good supervision, but without this, I think, basis, I think it will be very difficult for each individual country to move.
Super. Thanks, Gabriel. There's a lot there. Some of these issues I think probably we'll have to keep for another day. In terms of the high level politics, but I'd like to bring in now Kristof.
Jonathan, if I may.
Yeah, just briefly, Pablo, because I'm quite keen to just allow the industry participants to have a word as well. But please go ahead.
I understand. I was told that to make this dynamic, the interactions and everything. Just two quick things to add to what Bernadino have done. Auto-enrollment, we all agree, is good, but we have to be very careful when we implement it, because the UK's way of implementing auto-enrollment in some countries is not possible, because it might be also unconstitutional, because it's voluntary for individuals, but it's mandatory for employers. That's why in other countries, auto-enrollment can only be implemented through collective agreements. And this is very important to keep in mind when talking about auto-enrollment. The UK model might not work. So this is very important. And secondly, sorry, Gabriel, I'm going to have a little bit of a disagreement with you on the transition. We do believe at the OECD, for trust and for funding reason, but also for trust, that introducing funded system, defined contributions by reducing contributions to the Social Security, for one of the reasons you said before, that ideological, but also because there is going to be a huge deficit, is not the way to go, because this is the most expensive way to go. The only way you can keep the transition okay is if you manage somehow to develop the defined contribution system with new contributions, or have a national agreement like the Swedes have, of moving 1 or 2 percentage points. But otherwise, the cost is very high, and Central and Eastern Europe is a clear warning that will lead to canceling the defined contribution system.
Thanks, Pablo. I'm going to be very rude. I'm not going to give Gabriel the right to reply, because I think at this point we'll have a fascinating but whole different conversation. But Thanks, Pablo. I think that point on the practical limitations of how to implement auto enrollment is really critical. Let me go now to Kristof, just to pick up some of the points that we've started to look at in terms of what government and regulators can do from the industry perspective to encourage greater participation, and thinking perhaps particularly about this education information side of things.
Yeah, indeed, and hi, Jonathan. Yeah, as Gabriel said, awareness and compulsion. Within the awareness, you have the you need to be aware of your savings, and you also need to have financial literacy to understand everything. So the awareness of the savings, we have the national tracking systems. I'm a Belgian citizen, so indeed in Belgium already for many years we have a very good national tracking system. I remember when the website was launched, my pension, that me and my colleagues were looking at our pension savings, and although we're working in the investment community, we are financial literate. It was really helpful to understand. And yeah, and the statistics, Gabriel, the majority of the member states have already a national tracking system, but still some large member states don't, like Germany. It's also good to see that there is also the European tracking system, the ETS, not to be confused with the emission trading system. We have the European initiative. The website is live as of April this year. I guess it's called Know Your Pension. So there's already a lot that is done by the authorities, and there's still some national authorities working on their national tracking systems, and there's still some countries that need to start working on the national tracking systems. So that's the start. Looking at education, yeah, it's obvious that there's one of the big issues in retirement savings is that, yeah, the population needs to understand the importance of retirement savings. So there needs to be financial literacy at all levels. People need to understand the importance of investment accumulation over time. So, but again, there's also already lots of initiatives. As everybody might know, within the CMU, within the Capital Markets Union Initiative, Action 7 is on financial literacy. Very recently, there was this joint initiative by the Commission as well with the OECD on promoting more financial literacy. I guess it's even with the Dutch Queen supporting the initiative. So a lot is already done, but again, there's a lot that still can be done. If I look at our own industry, if I look at my own company, Candriam, we're really encouraging all our investment professionals to go out in their own community, in the educational system, in their own community, to educate at universities, high schools, secondary schools, to educate people, students, on economics, on financial markets, and on the importance of retirement savings.
Thanks, Kristof. And just sort of trying to look at this question of the behavioural nudges a little bit more. I mean, we've heard both that auto enrollment is a very successful tool, but both from Gabriel and Pablo, that there are some very significant potential political limitations to using it. So, Ankul, from your perspective, obviously, your firm has got a very international footprint in the pension space. What are your reflections on how we might use auto-enrollment or other behavioural mechanisms without sort of falling foul of some very complex politics and local labour law across Europe?
Yeah, so Jonathan, I'm going to say conceptual in terms of the application of it and effectiveness of it and how it's been used in UK and US. I fully accept that there are lots of legislative complexities in Europe in this issue, but you know, as Pablo highlighted, I think auto enrollment has been a very powerful strategy. It has improved retirement plan participation, but what's really important is to stress on the design of the plan and how it's implemented. One has to be really careful in implementing these plans, otherwise they can have exactly the opposite effect. If they're imposed on the population, they can have an entirely opposite effect to what they are capable of. So it's almost like a really powerful tool, but only used at the right place in the right time. Now, when it is applied, what we found in US is auto enrollment, when used by companies, has been effective in keeping 9 out of 10 participants in the plan from 1 year to another, right? So the opt-out rates are extremely low. Gabriel mentioned the opt-out rates in UK through the NEST programs, and they have been extremely effective. And there's no kind of doubts about it. We would in fact say there is another addition to it, which a lot of countries can benefit from, or companies can benefit from as executed, which is around auto escalation. So setup of auto increase feature in the plan, if you have an auto enrollment plan, and again, our research shows that that auto increase, because it's a default and it's done systematically and it's something the employee is signing up to right at the beginning, they stay with that auto increase. Now, in effect, that's all the technical kind of setup of the plan. But what it really gets us is it sets really good habits, encourages people to save, to invest in their own long-term future, which is a problem, which is a huge problem across the system. Second, it helps us reduce the barriers to investing. That really allows access to a large pool of investors to a system which is priced really competitively because it's sourced en masse because of the economies of scale. And when you look at the experience in UK and US and Australia on these, what we found is really simple, low cost and diversified defaults have been incredibly successful in engaging the population. Now, once somebody is engaged, if they then want to modify their plan, that's great. But getting them engaged, getting the foot in the door is the one thing these plans do incredibly well.
Terrific. I just want to pick up one other theme that Gabriel in particular raised, which is this question of the nature of the European market, the availability of the right products and also the right incentives, and how you operate between the European and national level. And Patrick, interested just to have an industry reflection on operating in what remains such a fragmented environment. We've seen obviously the major initiative, the PEP, that Gabriel and colleagues have really worked on together with the industry. But just to give us a view on how we can overcome some of these issues.
Sure. I would like to start first with some figures so that we can have an idea of what we are talking about in terms of volumes, because we haven't mentioned what is at stake to some extent. As of end 2019, the European pension assets represent close to 10 trillion euro, which is huge, with DC representing 40% of these assets. But with a growth of DC, which is much faster than the one of DB. Over the period from 2017 to 2019, it was plus 8% per annum on average versus 3.8 for the DB. And it will continue to grow for sure in order to compensate for the decreasing replacement rates and the switch from DB to DC. And according to the same study, by 2030, the DC assets could reach 10 trillion. Just as this figure in mind, it's important. So it's a DC market is, I would say, so it's big and it's a growing playing field, but it is fragmented, as you said, and with country specificities, different system. And as Pablo mentioned, you've got market with historical players within the DC system. You've got historical DB markets that are actually representing today half of the pension assets, but that are now facing more and more challenges, and with low interest rate, increased longevity. So they are resulting in underfunding of this fund, and this market will gradually shift to DC. And finally, you've got the last category, I would say, which are market with public schemes with kind of, I would say, generous replacement rates but which are not sustainable anymore. This typically is the case in France or in Germany. And in those markets, they will try to increase the part of the private system. So it's not a single market, but it's more local markets that we have to address, and we have to be flexible and also innovative to adapt to these different markets. And it's not only, I would say, investment solution. It's also advisory. It's financial engineering capabilities. We have to design a retirement plan with different features according to the countries. Think about decumulation and also services, and we'll come back to the digitalization later on. So we have, for sure, a strong growth ahead of us. But DC plan, and it was mentioned by both Gabriel and Pablo, I think DC plans can be pillar 2 or pillar 3, could be mandatory or voluntary. And if it is voluntary, you need for sure an incentive from the regulator in order to encourage people to contribute to the scheme. We have done this in France 2 years ago with the PACT law that encourage people to save with a tax benefit. But I think it's very, very important because the replacement rate is decreasing across the board, and it will create an income gap at retirement. So meaning that the only way to address this gap is to encourage people to save more on their own. And I think we won't have a strong development of DC voluntary plan without an incentive. I think that's impossible. And the development, of course, won't be the same in all the countries, because you've got countries with already a strong developed DCs and other countries with less developed DCs. And all this depends actually on the generosity of the existing public system.
Patrick, thanks. Let's stay with digitalization actually, because this has been a terrific discussion so far. But many of the themes that we've talked about have been themes that have been on the table and we've been grappling with as an industry and policymakers for a number of years. The one thing that is changing at an extraordinary pace, indeed, one of the things that's enabling us to have this conversation virtually today is the technological transformation that our societies are going through at the moment. And I'd like to just take a moment to ask all of you, actually, perhaps just staying with Patrick as you raised the subject, of where do we think some of the benefits, some of the risks, some of the challenges are of a more digitally delivered set of financial services, whether it's through the advice process, or where is this taking us, so that we can actually perhaps start to kind of reimagine how our customers will engage with pensions through smartphones, through robo-advisors, and let's just take a moment to talk about that, and then we'll come on to ESG, which is also arguably the other big thing that is going to transform the way in which we think about finance and our relationship with our money. So Patrick, robo-advice.
Yeah, okay, you will think I like figures, but I will start again with some figures I've just found yesterday, actually, showing that the robo-advisor market is really booming. We expect by the end of this year to have $1,400 billion under investment through robo-advisor, when it was only 100 billion end of 2016. So you see the growth in 5 years, with only at this stage 70 million users worldwide. So penetration rate is still low, but for sure it will grow in the future, and also technology will improve. And I think it's particularly important for the young generation and also in emerging market countries, for sure. So digitalization, I think it's good because it can definitely help to better understand the issues of retirement for people, because it delivers user-friendly tools like profiling tools, financial education videos, and also services like portfolio monitoring, reporting, and that should result in a better involvement of people. And I think also it means education. I think it's one of the benefits of robo-advisor. Why does it mean education? Because a robot provides you with a rapid diagnosis on your individual situation, and it results with a personalized allocation. Then the robot, I think, facilitates as well the awareness of the necessity to save for retirement with the questionnaire, simulation, regular alerts. I think it's, for many people, it could be, or it is, a wake-up call. And I think to some extent it helps individuals to take the kind of the ownership of their retirement plan. Then I think it's also an improvement, because it is a kind of a super personalized solution. Today we have a default solution, which is good, that is commonly proposed. But I think the robot is one step further, the default solution. Default solution is good, it's much better than cash, but to some extent it's a non-decision. You don't know what to do, default solution. You have a robot, you can have a more personalized solution, and I think it's better. And then it's also, it's dynamic, because you can adjust your profile at any time. If you want to change your investment horizon, your risk profile, your objective, all this can be done through the robot. Maybe if you give me just maybe 2 more minutes, I would like to also to share with you the result of a study we have done. And it is actually based on our own experience with our robo-advisor, which is up and running for 4 years now. This year, our Investors Research Center made a study on the effect of the robo-advising on a large sample of French employees having an employee savings plan with us. So we analyzed the behavior of a sample of 20,000 users of the robot compared to 60,000 non-users. What did we find? So we found that relative to self-management, having the robot is associated with an increase in the time spent by investors to monitor their portfolio. So they got some interest in looking at it. An increase in trading activities. People who have the robot, they are willing to increase their investment, to bear more risk, and to rebalance their portfolio in a way to keep the allocation close to the target, to the proposed target. Because one of the features we have incorporated in our robot is to send regular email alerts to the individual to rebalance the portfolio. If the allocation is drifting too much compared to the targeted allocation, we send an email. And then if it's up to the employee to decide to implement this allocation or not. And the rebalancing policy is something that is more commonly used for institutional clients, but actually we do it for retail clients. And at the end, they have a higher risk-adjusted return. So I think that's something that is important. And at the end of the day, I think it facilitates to promote the financial inclusion. And I think we are typically here for encouraging people in terms of savings in DC plan.
That's fascinating, Patrick, but particularly the engagement through tech with sort of occupational workplace DC, which is obviously still the dominant form of delivery. I just want to give Ankul an opportunity to come in on this, because Vanguard obviously is active in both in all parts of the DC market, whether it's sort of the personal or the workplace, and whether what we've heard from Patrick in terms of that transformation of engagement and ultimately outcomes is something that you're seeing as well.
Absolutely, Jonathan. I think the key point I kind of take away from Patrick is digital technology allows us to deliver personalized solution at scale. I think this has been the biggest kind of dilemma facing a lot of financial firms, which is either we can deliver really personalized service or we can deliver it at scale and low cost. And digital technology is a huge enabler. It allows lots of not just firms but platforms to give access to investors and to information, to video-based education, to chat-based customer service. So all of a sudden, it kind of enables the service delivery in a very big way. And what we found through investor research is that most members in DC schemes actually prefer this channel. They find it very engaging. They find that it reduces their barriers to take their own finances in their hands. And in fact, what we find is often investors in voluntary pension systems are highly engaged. They're themselves proactively looking at tools, whether it be a video, whether it be, information on demand. In fact, and one of the research we did with our investors in US was how often are investors logging into to check their account. What we found was investors were logging into their account very often to check their balance, but not making changes very often, which is precisely what we want to see, right? We don't want people to make changes in the face of certain market events if their overall strategy makes sense. So what we found is digital technology has allowed us to deliver higher quality service at the same cost to the firm and get a higher level of engagement from the audience. So this is literally a win-win. It's almost a technological step up that is almost irreversible as we see it.
Super. And I'd like now to come back to Gabriel and then to Pablo to get their reflections on this. I mean, Gabriel, obviously in the context of the PEP, one of the big things that we talked about was that there was an opportunity for this to potentially be the first truly digital product. We also talked about some of the implications for regulation in terms of disclosure, that we could move beyond the A4 prescription of the 3-page kid that had the prescribed font size and the different the prescriptions with respect to content. Do you feel optimistic that regulators and the industry are ready to make this kind of transformation?
Well, I think that we have gone far, I would say, with the way that we designed the PEP regulation on that, and then now the implementation. Of course, the devil is in the details, and the jury is still out there to see, if this really works and if people take it, of course, and how it's going to be implemented. But I'm quite proud of the work that was done in this area. And this was one of the really important elements, because if we want really to keep the cost down in terms of provision of long-term retirement savings, it's definitely also by the use of more digital technology. So, when we look, for example, of the key information document of the PEP, it's the first one, I would say in financial regulation that was built up not on thinking on an A4 piece of paper, but on a screen of a smartphone, and the way that the layering of information is dealt with. And one aspect that for me was always very key, it's that the way that you present information, it needs to be engaging, engaging with people. If you just put blocks of text, people after the second phrase they are sleeping. You need to do it through icons, through questions, through really very concrete elements that people can engage with. And so that's what we tried, and I think that I'm happy with the result. But of course, it's it's work in progress, and let's see how it works in reality. But let me touch one point that I think it's also very important going forward. We really need overall, to lower the cost of distribution. I think that this is one of the most important pieces of cost in retirement savings. And I think that there is a clear need to bring down the initial cost of advice when you're talking about a retirement product. And of course, you can do that much better, I would say, in an occupational pension side, because of course the employer can help a lot in terms of giving the information and making people, of course, as part of a collective, to engage then and to move ahead in terms of the pension plan. It's more difficult, of course, on an individual basis. But I think that the real challenge, if I would really launch a challenge to the gentlemen of the industry around in the panel and to everybody around, is really think about how can we use new technology to bring down the initial cost of advice. And I think that we should think about concepts like open finance, for example, to look at what can be done in terms of reducing the cost of profiling, reducing the costs of the suitability analysis that needs to be done for the different products. I think that this could be the key for really lowering the cost of provision of pension. So please, guys, work on that, and you will have from the regulatory side some open eyes on this.
It's a great challenge, Gabriel, and one that I know we're familiar with from some of our discussions on the PEP. I'd like to come back to Pablo and ask you to sort of, again, from your international perspective, to maybe sort of bring some of this together in terms of how we can ensure that technology can benefit customers, and indeed where you see good or best practice emerging from different jurisdictions around the world.
Well, I have to agree with everything that has been said, and the industry is doing a good job. I like the challenge that Gabriel have put on the table. I have written here that all these things of the dashboard tracking system that the industry and some regulators are putting in place in many countries for people to see and understand what they have is going forward, and it's very good or it's very useful in terms of trust, but also people to be able to make the right decision. One thing that has been mentioned, but I think it should be highlighted even more, is to use technology to have projections, calculators, I don't know how to call projection tools, for people to be able to see what are the outcomes of them be proactive if they save more or they retire later. That has been developed in a few countries. Chile is an example of that, which is quite useful. Obviously, it always have the problem that Gabriel referred to it before. At the end is the retirement incomes at the end, the day before you retire. And it has one very important problem that we discover analyzing this in many countries is how to explain the concept of probabilities. Because people are proactive. And when we tell them, well, if you do that, the probability that you achieve that, it will be. But for people, normally they come back and they say, what do you mean probabilities? I only retire one, and I get it or I don't get it. It's a 0-1. So this is a key issue in terms of using technology and communication. Because at the end of the day, most of these technologies for communication, as many of the speakers were talking about. And of course, that led me to the third point, retirement advice and communication campaigns. But this is the traditional way of looking at, if I can call it traditional, because as we know, still going on digitalization. And I would like to put on the table, copying Gabriel, if he allows me, another challenge to the industry. It's something that we are thinking about here at the OECD, because it's one of the key issues that we want to look forward, which is, what about bringing in digital ledger technologies, DLT, as it's called, in order to enroll, manage information, provide protection, transparency, and also the issue that Gabriel argued, reduce the cost and therefore the charges. This is done in many arenas, not in the pension world. In some countries, in particularly in Latin American countries, the industry is coming together to create a centralized digital tool for people and employers and the regulator and the supervisor to know where they are, to manage the contributions and to have all the information. And the idea is to do that, but to do that also with digital ledger technology, because we know that it increased the level of security and protection. I don't have any idea how to do it. I don't know how practical that can be. It's just an idea on the table. We are starting thinking about that, and when we start thinking about these kind of issues in the OECD, we just go to all the stakeholders and talk about it.
That's a great challenge, and I'm tempted to move on quickly before we collect more challenges. The one thing I'd say, at the risk of abusing my position as Chair Pablo, is that we're starting, at least in the funds environment in the UK and Europe, to think about the idea of a tokenized fund and using DLT technology to deliver the investment fund in a much more efficient and hopefully over time cost-effective way. That again, it's a topic for probably another day, but I think you're absolutely right, and we'll speak more offline, or indeed happy to talk in a public forum about it as well, because I think we're in the foothills. But that is absolutely correct, and we'll come back to some of these issues around cost in the final segment in a few moments around value for customers, which is really critical. But before we do that, can I just take a moment to kind of go to the engine room, as it were, of investment, and I'm going to come around to all of you to ask you a little bit about different aspects of this. We've got a question that you put on the table, Pablo, about probabilities. And probabilities, of course, are driving a lot of the investment management process in terms of thinking about strategies such as life cycling and how we make sure that we can adjust risk effectively over time. I'm just going to come to Patrick initially to talk a little bit about why in this environment that we've discussed of a degree of risk aversion on the part of customers, some difficulties in persuading European savers to trust the industry, we think life cycling is still a well-suited investment process to base our offering.
Yes, absolutely. I think the life cycle approach is very well suited for retirement, and it offers multiple advantages. First, I would say it provides a personalized solution for each employee according to its investment horizon, risk profile, and also decumulation option. Second, it offers a great flexibility with the possibility to modify at any time your investment horizon or the risk you are ready to take. Third, the adjustment of the asset allocation, the glide path according to the profile you have chosen is automatic and progressive. And finally, maybe I should have started with this one. It's very well adapted to very long-term investment horizon, which allows, and I think it has been mentioned by Gabriel, which allows to take more risk when you are young, far from the horizon, which is your retirement, and then consequently to benefit from the equity risk premium and or to the illiquidity premium if you invest in real assets, which is very well suited for life cycle solutions, for example. And it is, of course, particularly relevant in a low interest rate environment we are facing for many years. And in addition to that, and that maybe to reinforce this all these advantages, I think that many academic researchers are supporting life cycle solutions. I think OECD published one paper many years ago, Bocconi University as well, and we have internally performed our own financial simulation showing that indeed life cycle strategies provide a robust downside protection, which is what I would say employees are looking for. The objective clearly is to maximize the return, but with a constraint which is capital preservation at maturity. And what we have done under different risk profile, actually the capital preservation probability for a lump sum exit at retirement is between 95 to 99%, according to 3 different risk profile: balanced, defensive, and dynamic. I think that's huge, but of course it's very long term. And each risk profile is actually associated with a specific capital protection probability. And of course, all this can be tailor-made or adapted to specific guidelines. I mean, in terms of country specificities, maybe geographic bias, European are not thinking like Asian or American. So I think we can adapt according to these different parameters. Risk profile, of course, and what I call go to or go through, meaning do I end with a lump sum at retirement, or do I continue to have my assets invested in order maybe to have some capital drawdowns and just to come in addition to my pension.
One of the big things, of course, as we think about investment and the sort of traditional pension investment strategies is the concern over the transition to net zero and sustainable and responsible investment is starting to overshadow nearly everything that we do, and one can understand why. And I'd like to sort of do a roundtable of everybody actually on this theme before we move to value, because it is simply so important to think about how we integrate thinking around sustainable and responsible investment, both into investment strategies for retirement, but also into the way in which we engage with pension savers about this very, very long-term savings process that, frankly, if we don't get this sustainability piece right, they will find that their savings are worth a lot less at the end of their lifetime. So just to start with Kristof on this, and again, sort of trying to bring together a number of themes here when we've been talking about how to engage. Do you think that sustainable and responsible investment, as well as being an investment necessity for long-term investment and pensions, would it provide us with a different way to engage with different generations, potentially building on some of the technological transformation we've already talked about, where we actually just create a completely different discussion that persuades people to save more?
No, absolutely. Sustainable investing, it's the right tool to engage more, not only engage with the investee companies, but engage with the investors. It was interesting to hear that Patrick mentioned that they're using their robo-advisors to analyze the behavior. We're doing exactly the same. And what we see is, of course, we are a pioneer in sustainable investing. We see that through the robo-advisor, we can clearly see that the younger generations are much more interested in sustainable investing. It's logical. It's the younger generations that will be impacted longer and more by climate change. So yeah, the younger generations, they care about climate. Think about Youth for Climate. They care about the environment. They care about sustainability at large. So they're really asking for sustainability in general, and especially within financial products like retirement products. It also, talking about value, we will talk about value. You know, the value of a pension is not only expressed in monetary terms, and the youth already understands. It's expressed also in other terms. You know, what is the value of receiving, let's say, 1,000 euro a month later, when you will need to pay 1,000 euro to have access to clear water? So sustainability is extremely important within the investment process, leading to better financial performance, avoiding certain risks, but also to leading to a more sustainable society where people will be able to enjoy their pension and not just thinking about financial results. So indeed, sustainable investing is an extremely important element for the future, for retirement savings, and the youth is clearly asking for it. There's a huge demand for it, at least if you do it well. And then looking at the whole series of European initiatives, the Action Plan on Sustainable Finance, that's really helpful. SFDR, you know, the main objective is to avoid greenwashing. You know, sustainability is about looking for, or sustainable investing is about looking for those companies that are best positioned, where the business plan is best positioned for the future, not hurting society. You know, sustainable investing is not about just, you know, excluding certain controversial activities. So yeah, people need to understand the difference between responsible investing and sustainable investing, but now the focus is on sustainable investing, and luckily the Commission is helping us in this field.
And Pablo, again, with your international comparative perspective, I mean, obviously we can see some of the different politics around climate change in different jurisdictions, and an emphasis that isn't always the same across the world. But insofar as you're looking at pension systems and the extent to which the theme of sustainable and responsible investment is impacting on the debate, is there anything from your perspective that you think is interesting that we can learn from? Oh, are you on mute, Pablo?
Sorry, I was on mute. No, as you know, and it was highlighted before, sustainability investment, or ESG, it's discussed everywhere. It started first with whether it was part of the fiduciary, and then we move on to have indices and data and all of that. But from the work we have been doing at the OECD and discussing with regulators, supervisors, and the EIOPA, the International Organization of Pension Supervisors, a sister company, issue their guidelines on ESG. One thing that we believe it needs to be solved is exactly how to incorporate ESG factors and risk in the investment decision of pension funds. How to do it. What type of models and metrics? And in this, the industry is essential to tell us, because we don't know how to exactly do it. We don't know how to tell regulators and supervisors to regulate and supervise that. It's the industry who is doing it. So far, what they are doing is using indices. The work we have done here at the OECD, looking internationally, is that there is a lot of question marks about those indices, because they can change a lot. That has led some people to use the term greenwashing. I don't think the term greenwashing is that very helpful here, because it's too much of a criticism, but it is true that one has to be careful about this thing. The key point is, and this is what pension funds, what we are hearing, they're saying, in the very large ones, they do it in-house, and they have the technology, they have the knowledge and the know-how. There's no problem. It's all the medium and small size. And the question is how to do it. What models they can use. Do they have to go to an asset manager? The asset managers have those models incorporated. All of that is essential that we talk about it, and we analyze it. And this is what we are hearing internationally. We're still a long way to go.
Indeed. And Ankul, just briefly, again, thinking about the European perspective, which I think you guys really have very strongly. What are your reflections on this, particularly, where the US is perhaps compared to Europe at the moment?
Yeah, I think on the whole, Europe is definitely leading the way on ESG. But I think when you look at the life cycle element, I think that's where we can probably get some insights from what we've seen in US and Australia and even UK. And, when I think of it, three things come to mind straight away. I think first thing is regulatory consistency. For instance, in US, we have the safe harbor legislation, which meant that diversified investment vehicles would be qualified for pension plans straight away. Similarly, we have kind of harmonized tax relief, which means that you don't have that difficulty when you're going across one state to another in US. Something like that would be really helpful for investors in Europe. The second point is around flexibility of investing, flexibility of choice, and that again engages the investor, puts a bit of responsibility on their plate to engage with the overall system. But that again has to be done sensibly by using a default so that they don't stray very far away. And this is something, the FCA, the UK regulator is, dealing with, is trying to improve in the marketplace. And the third thing is actually Gabriel's point around fees, which is high fees would scare investors, quite literally. Even if somebody has the inclination, if they see a high fee or high price product, they would immediately hesitate to a great extent. And this is where we believe that asset managers can really create large scalable funds, large scalable solutions, and offer really good value for money. So we typically kind of tend to learn these three things. On the whole, we're very strong advocates for life cycle. And rather than taking a conceptual or a technical angle on it, I will take an investor's point of view. What life cycle investing fundamentally does is it puts a high degree of security in the minds of the end investor because they start saving at an early age. They become familiar with saving. It becomes almost a behavioral habit for them to save, to look at their balance, and to rely on it as they get older. And then when they move out of the workforce and retire, then that's something they can depend on. In fact, this observation I've just shared with you was the key observation which allowed us to convince the European Parliament and member states that PEP providers should be allowed to offer life cycle as a default option, and not just a guaranteed product as originally proposed in the regulations. Because the high cost of these guaranteed products in the current ultra-low interest rate market is really prohibitive. It's obvious to everybody, but we've got to look at options beyond that. So, my key message is all about, the complexity of the system, the complexity of the offer really breeds contempt. And when the system is very complex and investors have lots of choices to make, they tend to, one, lack some trust with it, and then their engagement level drops. So we need to make it simpler for them, transparent for them, and give them access to these services at a good value.
Terrific, and that really takes us very neatly onto this sort of final round of what value really means in this new world, this world of technological transformation. We've talked about the potential to lower the cost of distribution, the cost of advice. We've talked about the role of technology in changing the way in which we engage, as well as the potential to completely transform the way in which pensions or funds are delivered using distributed ledger technology. The world is going to change fundamentally. But what does value mean in that world? And Gabriel, for this last round, I'd like to go back to you initially to sort of bring some of this together and from a regulatory perspective, just talk to us about what is therefore the key component what are the key components of a good value pension savings product?
Well, thanks, Jonathan. If you allow me, just 2 points on what was mentioned before, for the sake of having some interaction. Just on the life cycle, and as it was mentioned, of course, it's a very important part also of the way that the PEP was built up. But I just want to raise one point in there, is that in order to make sure that we are driving, of course, also investment policies that offer good value for money at the end of the day for consumers, there's a number of elements in the PEP regulation about the use of risk mitigation tools. So it's not just to define a life cycle strategy and that's it. No, the provider needs to show to the regulator that hopefully through stochastic simulation, that your investment policy has a high probability of delivering. By the way, delivering not capital preservation as it was mentioned, but capital preservation plus inflation, which is, of course, should be at least the minimum target, in my opinion, to deliver for a customer in a product like this. So this is in there, and that, of course, it's not something that you will, you transmit easily to the consumer, but from a regulatory perspective, these risk mitigation tools is quite an important element of this life cycling. Then on the ESG, just one point that I think it's quite crucial. We still don't have in the pension funds regulation in Europe this concept of the double materiality included, that I really think we should, because talking about ESG and transition, it's not only about the risks that, of course, those types of investments can have on your portfolio. It's also about what can you, as a pension fund, induce in terms of the impact out there, of course, also in the companies in which you invest. And so this element of double materiality, I think it's fundamental. And actually, I think that, as it was mentioned, it's a very important element of engagement with young generations, especially because, I'm sure that young generations have much more the wish to invest, in projects that are sustainable, that will give you, of course, I think a wider reason to be part of a pension plan. And let's be honest, you know, right now every pension provider should be thinking on really investing in an ESG way, because, you know, this is going to be materializing in how many years? 30, 40, 50 years. You know, you need to invest in sustainable products. So that, for me, it's very, very clear. Now, coming to the issue of value, and I think it's all of this is linked, because I think value, the way I see it, value and the value for money needs to be seen well beyond cost. You know, cost is important. It's a driver, of course, of value, that's for sure. But I think that if you think in a pension product, you should look at value in a more wider context, and so you know, you should look at not only cost but also at the risk that is involved, the time schedule that you have for the investment, so the time horizon, and of course also these elements related to the sustainability of where you are investing and the sustainability of the outcomes that you have. So I would argue that we have been focusing a lot from a regulatory perspective, actually in all the financial sector, I would say, in two main things in terms of driving consumer and investor protection. It was about disclosure and about compliance. That was the focus of you know, the regulations around these elements. I think we need to go beyond disclosure and compliance, and maybe by doing that, we can reduce a little bit also the overwhelming you know, tier of regulation that we have on disclosure and on compliance, if we push much more for what I call fairness testing, you know, or value for money testing, where you should really have a good understanding and proof that you put the client at the center of your policy, that you have processes to adjust the products if they are not delivering really value for money for consumers. But in order to do that, as I said at the beginning, my first intervention, I think we need to change the parameters. We need to change also the benchmarks. We need to change a little bit the paradigm in here. And we need to have also products which are more simpler, because at the end of the day, this will drive down cost also, and will increase the value for money at the end of the day. A last point for me in terms of value for money, I think in a pension context, you should not only look at you know, accumulation period. I think we should also look at value for money in a decumulation concept, and I think that's where innovation really should be also put on by the industry. I think we need really to look at post-retirement elements, with longevity, of course, becoming greater, with also the possibility of people, you know, with higher longevity to have periods of dependency that will increase. That's unfortunately the case that we see. So you need to adapt the way that you decumulate from a pension pot, not as in a traditional way where usually you have a kind of just an annuity, but to have mixed elements of drawdowns, of possibilities to cash in some capital, but also services, you know, because people in the retirement phase, they will probably need much more also services, you know, that are provided to you either in your home or in a home care, etc. So I think that innovation linking to this decumulation should also be part of the value for money that you get from the pension. But for me, it's essential that we move also from a regulatory perspective beyond just disclosure and compliance, and to move much more in terms of this value for money testing that all the products should pass.
Super, thanks, Gabriel. Pablo, from the OECD perspective, have you got a view on how we can achieve what Gabriel, I think, has quite correctly set out, which is how do we move beyond cost and disclosure to a way to more objectively measure value? Oh, mute.
Yes, I think this is, it's not easy to measure value, as you say. The cost is easy to measure, but the value for money, and particularly the quality feature, is very difficult. Gabriel mentioned something very important at the beginning of his presentation, at the beginning of the session, that is essential here. At the end of the day, the value for money it's what you will get the day you retire. It's very long term. It's not only about the cost. It's about what you will get. It's at the end of your accumulation, and also the day that you try to convert that pot of money into a retirement income. And this is something that only happens at the end. So it's a long term that it cannot be a value in the short term. And this, it's a problem I really, really don't know how to address, because first it requires time. Countries that have had defined contribution pension arrangements for at least 40 years or 35 years of contributions or accumulation, then you can assess this kind of things. Obviously, you can use stochastic modeling and all these kind of things, but that is internal. With communication with people is extremely difficult. So it is about service, no question. It's about cost, but at the end of the day, is the long-term outcome, which is retirement income, and that is very, very difficult to measure. Obviously, there are two things that are very important also here, looking forward at long term. One, and I know the industry sometimes don't feel at ease with this type of comments. I hope you're okay with me saying it. There is a need for competition. Pension markets are by definition not competitive markets for many, many, many reasons. And how to introduce competition among providers is very tricky and very difficult. There are countries that had or introduced competition by allowing people moving from one pension provider to another pension provider. All the international experience is that backfires completely. And there are countries that have come out with tender mechanisms of assigning new entrants to new providers for a number of years. Basically, it's the idea of the threat of entry that normally is in the competition literature. That is one key issue. And another one somebody mentioned, I'm sorry, I forgot who mentioned, talk about the, I think it was Ankul referring to the US, the simplicity of defaults to get people engaged. That is also very important, because for many people, the outcome sometimes, because they don't want the financial education, is about having a default that will deliver some kind of retirement outcome. And I end up with what I started. At the end of the day, the value for money is at the end of the road, when people retire and have a retirement income.
Terrific. Well, Pablo, I think between you and Gabriel, you've given the industry participants a lot of very good challenges this afternoon. So I'm gonna pick up that challenge straight away and go to Patrick and ask for perhaps you to respond to that in terms of how do we deliver high quality value products, and how do we ensure that competition is as effective as possible? Because I think there are some jurisdictions in Europe, some not too far from where I'm sitting, where price is actually hyper competitive now, but that is perhaps at the expense of a discussion about value. And then there are other jurisdictions where we're perhaps at the other extreme. How do we get this right?
Well, first of all, I think we are all aiming at delivering high quality and good value products, of course. And a good value product, I think, is a product that answers to the client's needs. I think that seems basic, but that's the way it is. And in particular, the risk profile and the investment horizon. We are talking about retirement, so this should be actually risk profile and investment horizon, the cornerstone of the solution we propose to the clients. But the difficulty is that for many people, and I think we have already addressed this, but for many people, retirement is something which is abstract because it is too far away. Pablo was talking about the horizon, which is 30 years from now, and for people it's too far away. It's difficult to think about that long horizon. But as we know, the replacement rate is decreasing. So at the end of the day, additional revenue will be needed to complete the level of the pension that anyway will decrease going forward. And especially with the longevity, which is increasing, we are living longer. So meaning what? Meaning the retirement will last longer as well, and we will need additional revenues. And the way it can be addressed for people, I think, it's only by saving early, so as early as possible, saving regularly, and saving significantly when you can, of course. But I think these three kind of simple ingredients are making a good value for a good value product. I would client side. I think any wise individual should do is to do that, to save as early as possible and significantly. Well, this is for the background, of course, because one thing is investing, is a saving, sorry, and the other thing is to invest properly. I think it's even more crucial. And when you save for retirement, and I think that's our role now, is the investment strategy should be adapted to the specific goal, which is retirement in X years. And typically, so you already mentioned a life cycle solution, which is, of course, one of the ideal strategy, I would say, for retirement saving, because it is adjusting the asset allocation over time, and it should, and I think it's Gabriel who mentioned it as well. It should take into account not only the accumulation but also the decumulation. I think if this is meant to be a retirement system, it should provide an income after retirement as well, not ending with a lump sum when you reach retirement. Because basically, what does an investor want? He wants that his regular contribution grow regularly by a certain percentage, net of inflation, of course, in order to save an income at retirement that will complement other pension income that he may have from the public scheme or the occupational system. And he wants also a replacement rate of, let's say, 70%, which is a kind of standard figures we have for replacement rate. And I think the objective of a good value product or investment solution is just to answer to this need. And I think it is an outcome. It should be an outcome-focused solution that fits this retirement objective. You are on mute.
I've done it myself now. This was going so well. Kristof, but maybe I should have stayed on mute, because I was going to ask you to pick up Gabriel's challenge actually around distribution and advice costs. And obviously we operate in an environment that's still very heavily bundled in many parts of Europe. And I'm just interested in your perspectives about how the investment management community can do more to ensure that those costs of reaching the customer, the last mile as it were, can be most effectively controlled and most competitive.
No, indeed, and more than willing to take the challenge of Gabriel and Pablo. Yeah, what can we do? We already talked about the advantages of robo-advice, digitalized advice. It really brings people quicker into retirement savings with good advice. As Patrick said, we see that people become more active, save more, look more often at their savings. So clearly, digitalization and robo-advice is part of the future, and it's part of bringing down the overall cost. Now the challenge, and I will throw the ball back to Gabriel, or in general the regulators, the challenge that we are facing is that if you talk about advice, you have a tool, but the best tools are not just giving advice, they allow the client to act, to what we call execute on the platform. So these tools also needs to be execution tools. And then we have the MiFID regulation. And indeed, if you compare it, I don't remember whether it's Pablo or Gabriel, it was Gabriel talking about how within the PEP, when we all were designing the PEP, we were already taking into account robo-advice, digitalization, especially regarding the kit, that it needs to have the look and feel that fits a smartphone. I challenge you on looking at MiFID and the profiling of MiFID. That's clearly not thought out of having it on a smartphone. So that really makes it's complicated. So I would prefer to throw the ball back if also the MiFID regulation would be more oriented and taking into account that the future of advice is digital, is using smartphones, is on platforms, and that we also need to be able to do this quickly, to do the profiling quickly, then for sure the cost will come down. It's obvious that human advice today, because still lots of the advice is human advice, this is costly. So yeah, advice is part of the overall cost, and it's a big part of the overall cost, but it's also very costly, the human advice, and we need to give the advice. We were talking about auto enrollment, but whenever the client enrolls into his retirement product, and hopefully at a young age, they need to have the best advice, because it's a extremely important decision that they will take which retirement product. It will really help them to have a pension adequacy. We were talking about pension adequacy. So yeah, they need to receive the best advice. And for the time being, it's mainly human advice. Tomorrow we will switch to digital advice, but this needs to be good advice. The advice has a cost. We, asset management industry, the distribution industry, we're trying to bring down the costs, but yeah, we cannot deliver a good quality product without having the good advice that goes with it.
Thanks, Kristof. And last word on this topic to Ankul. Again, sorry, we're doing a lot of US comparisons, but I think we're drawing on your expertise in this area. Just briefly, have we got lessons to learn from the US in terms of the scale of the market and cost efficiency and delivery to the DC market?
Thanks, Jonathan. I think in US we see again the three trends that I kind of pointed to earlier, which was around regulatory consistency, freedom of choice, and then offering the investor what we'd like to call a fair deal in terms of pricing of the option. Now, I think there have been lots of comments as we've been having this discussion, and I do want to address a couple of them as I talk through this. I think as we know, the US system wasn't built in a day. The system was built and then amended over time, and new legislation brought in at various points to improve it. And again, I think we have a once-in-a-lifetime opportunity with the European system, European DC system being designed at this point. So I'll address these points from the point of view that value for money is all about balancing cost with the service receipt. And what we find is in US in particular, there has been a single set of rules which all the market players have been playing with. And then the competitive forces mean that each market player or asset manager who's providing these solutions is trying to get economy of scale and is constantly bringing the cost down on their offer to be very, very competitive. So all of that happens only when you have a consistent regulatory framework, a consistent set of rules you can work with. The second thing is around freedom of choice. In US, we see that whether we talk about accumulation or decumulation, there is a whole range of offer in the marketplace. So when I think of accumulation options, there are providers who've gone for simple products, which are transparent and low cost, no frills, completely diversified options. There are providers who've gone for product differentiation. We are actually quite supportive of both approaches. It really unleashes competitive forces and offers a selection to the end audience. You can see the similar thing with decumulation, which is in decumulation, the nuance with decumulation is that it is driven by personal circumstances. And this is where digital tools can be very powerful. And in US, you can see lots of providers coming up with lots of different digital tools to try and provide support to the end investor in self-help. You go up to the system, you select something that works for you, and there we go, right? Now, for investors who've got a larger balance, of course, there'll be lots of different forms of advice which can also come in, particularly for decumulation. And then my third point was around the fact that fee is a part of the equation and not the end goal. Our end goal is to ensure that the members get access to the service at a fair price, at a what we'd like to call a fair deal. This means being able to kind of seek out appropriate financial advice, guidance, investment products, and not being charged unreasonable fees for it. So I think those are the three things we see in US broadly playing out. And I think the themes which might help us in how we shape the European market.
Super, thank you. And I think there's a sort of common thread coming through all of these comments. I'm slightly reminded of a comment by Warren Buffett in a rather different context in terms of US investing, that price is what you pay and value is what you get, and how we define that value is absolutely critical. We're coming to the end of this session, a little bit like Jules Verne, around the world in 80 days. I think we've gone around the pensions world in 2 hours and covered an awful lot of ground. We've got a couple of questions that I'm going to try and get to, and I may just pick on a couple of people in the panel to lead off, and then if we've got time, we'll allow others to come in. The first is a question around the potential need for minimum guarantee provision during decumulation as a mandatory condition. And this takes us right back to the whole issue of tolerance for capital market risk. And maybe I could just go to Gabriel briefly, if that's possible, so that we've got enough time to pick up some other questions before we close in about 7 or 8 minutes.
Well, on that, I would say that we need choice, and I don't advocate for kind of a mandatory minimum guarantee for all this type of accumulation of these products. For sure, choice makes a lot of sense, because it depends. If you look at from a risk perspective, I think you need to look at from the individual situation of the person. For some persons, of course, if your private pension pot is a good part of your overall retirement, then of course it's important for you to have an element of more guarantee type of mechanism in the post-retirement. But if it's just a small percentage, why do you need that? Why do you need that extra cost? So I think that freedom of choice should be there. And as I said, I believe that we will not have for sure in the future this kind of rigid type of drawdown policies. I think that we need to have flexible ways for people to use their pension pots.
Yeah, terrific. And on that question of choice, I think there's a broader question around choice in general, which again takes us back to some of these big behavioral questions. I'm going to take that straight to Pablo. How much choice do we provide investors? And there's then the comment that convenience is more important than full flexibility. I'm not sure quite what convenience means there, but there is this fundamental tension, isn't there, in terms of how we operate DC. Pablo, thoughts in a couple of minutes.
From our point of view, there is not tension there. You have to provide choice. This is the nature of defined contribution arrangements. But as we have been talking through the 2 hours, you need to have a well-designed, simple default for people who don't want to exert that choice to be protected a certain degree. The question and different jurisdictions will define differently what level of protection and what type of protections they want to provide. So the defaults will change from country to country, from jurisdiction to jurisdiction. But you can have full choice to adjust to the different risk profiles of the different individuals, and a well-designed default for those who don't exert the choice.
And there's a comment here that and I'm going to just put this to Kristof, that again takes us around this question of confidence and financial literacy, the extent to which we expect, particularly those that are later entrants into collective occupational DC. Is it fair to expect them to understand the risks involved? Are we loading up too much in terms of our expectations of financial literacy here?
Yeah, indeed. But I'd like to come back to first what Pablo said and Gabriel. So yeah, there needs to be choice, but we see that a lot of people lack the financial literacy to use that choice. So indeed, the default option is by far the most important element. Choice is the second element, because in order for people to take the right choice, they need to have the financial literacy. Otherwise, they risk taking the wrong choice, and then they're even worse off at retirement. So the default option is extremely important, unless, yeah, we have the financial literacy. Yeah, coming back to the question, if I understand the question correctly, what about people starting saving later on, also being afraid of capital markets, of volatility? Do they understand it correctly? Yeah, well, we need financial literacy for everybody, not only in the schools for students. We need financial literacy for even the elderly, because indeed, although we would prefer that almost everybody starts saving for their retirement at a young age, what we actually notice is that people start saving at a rather later age, at the middle ages. So yeah, we also need to educate those people. This is going to be more complicated because they are no longer going to school or university, but they clearly need to be educated, because yeah, these people are afraid as well. It's what has been said in the beginning, you know, there's a mistrust of the capital markets. People are afraid of losing money. It's a very human reaction, the loss aversion. But we need to educate these people, because a natural reaction is then, okay, I don't want to lose money, I go for the guarantee. But then the people don't understand that a guarantee is extremely costly, and that's exactly what you don't need when you go in retirement saving, because it's the most expensive solution. And at retirement, you have a guarantee that you will have lost money. You will have your capital will have been deflated. So I guess financial literacy, we need it at all levels for all generations.
Terrific. And I see Patrick and Ankul want to come in. Just a minute each, if I may, just so that we can start wrapping this up on time. Patrick, over to you.
Yeah, sure. Yeah, I just want to react on decumulation, because actually what people want for the decumulation period is a security and flexibility. But it's difficult to combine both. You know, if you have security, for example, with an annuity, you won't have the flexibility, and conversely. So I think this is something which is important to have in mind. And then what part of your pension asset is, you know, for example, your DC plan. It can come in complement, in addition to a basic plan, or it will be all your pension. So you have to think about this. And then there is a last comment. There is something which is gaining traction to some extent. It's a collective DC. I think it has just been approved in the UK. It is up and running, I think, in the Netherlands, in Canada, and I think it's a pooling of you know, the DC, meaning that the risk is then spread over much more people than it is in a DC plan, where you take all the risk. With the pooling of the risk, you know, it makes I think more I would say more how can I say that, adaptable, or more better acceptable by people.
And Ankul, last word to you.
So I think rather than answering the question, I just want to highlight the role that education can play in this space. I think at the end of the day, the investor is faced with, you know, three simple, but when you look at it simultaneously, very complex questions. The three simple question is, how much do I need to save? How do I invest it? And then how do I spend it? Right? Individually, they're not very difficult. But when you combine all of that together and you start, you know, thinking about a single individual's life, their multiple goals, their different behavioral needs, this becomes very, very complicated and extremely difficult. And this is where interactive financial education, financial literacy can play a huge role. And the digital tools we have, then the familiarity everybody across different age groups have with it, gives us that opportunity to accomplish it. So we've got a difficult problem, but we do have the tools to resolve them.
Super. I think that's a great place at which to stop. There are a number of challenges that we're taking away that I think sort of center on both sort of cost efficiency, but also just effective delivery to connect with both this generation and the next generation of European savers. We could have talked, I think, probably for the rest of the day, or indeed the rest of the week, on these subjects. I'm deeply grateful to the panelists, to Gabriel, to Pablo, to Kristof, to Patrick, to Ankul, for giving up their time. I hope that this has been an interesting session. I've certainly taken away an enormous number of observations that will be valuable, I think, as we think about these questions. So on behalf of EFAMA, thank you all participants as well as panelists for contributing to this European Retirement Week event, and I look forward to catching up in person in 2022. Fingers crossed. Stay well. Thank you very much.
Bye-bye. Thank you.
Thank you. Bye-bye.
Bye.
Well, good job, Jonathan.
Yes, indeed.
Voilà, Myriam, nous ne sommes plus qu'à deux.
Oui, pardon. Je suis occupée à sauver les Q&A et j'ai pris plein de photos. Je vais les envoyer de ce pas.
Bien passé,
Ça,
hein?
ça s'est super bien passé, hein?
Oui.
C'était hyper intéressant en plus.
Oui, en plus, hein, oui, je trouvais ça aussi. Ouais,
Ah non, c'était vraiment très intéressant.
Oui, non, je suis content.
Antonio est encore là. Je crois qu'il y a encore des participants. Oups.
Great session, yeah, Antonio. Yeah. Well, is there a function to save these, or you need to copy paste, or?
No, I've saved. There's a function to save them.
Oh yeah, okay.
Yeah. Anyways.